We start with the increase in the price of goods Americans buy and how much you can buy with an American dollar. According to the Consumer Price Index, which was released on Tuesday, the report says that prices increased by 0.1% last month and 8.3% from a year earlier. Gas prices have fallen, but the cost of food, rent, and other goods has not. Many economists had anticipated that inflation would cool, but the increases have persisted for core items in the family budget. Wall Street convulsed. The Dow, NASDAQ, and S&P were all down sharply. We'll get to the markets and economics in a minute, but start with Nancy Cordes at the White House.
John, today's report dashed hopes that inflation had officially peaked and was on its way down. Instead, the price of nearly everything went up and wages could not keep pace.
Government figures confirmed what most consumers already sense. Inflation isn't easing. Groceries up 13.5% since last year. Electricity up 15.8%. Car repairs up 9.1%. Rent up 6.7%. The bottom line, according to Moody's, the average household is spending $460 more a month to buy the same goods and services as last year.
Just a catastrophically high inflation rate.
That rate sent stocks tumbling today. The S&P sank by more than 4% as the markets braced for more interest rate hikes from the Federal Reserve in a bid to cool the economy.
The reason is clear. The Fed is much more concerned about prices right now than it is about the labor market.
Typically, lower gas prices bring down the cost of other goods. But so far, that hasn't happened, even though the average price of a gallon of gas fell 26 cents in the past month.
I will not make as much as I was hoping to.
Robin Fields runs a toffee company near Chicago. Ingredients are her biggest expense.
For example, butter and chocolate increased anywhere from 8 to 15%. And it doesn't look like it's going down any. It's just my butter just keeps going up.
And while President Biden celebrated the new Inflation Reduction Act today, many of the law's health and energy savings do not kick in until next year or beyond.
We're making progress. We're getting other prices down as well, but we have more to do.
A new U.S. Census survey revealed today that income inequality hit a new record last year. Interestingly, it also found that childhood poverty was nearly cut in half thanks to COVID-19 stimulus payments and an expanded tax credit. John?
Nancy Cordes at the White House. Thank you, Nancy. Jeanna Smialek joins me for more. She's a Federal Reserve and economy reporter for the New York Times. So, Jeanna, you've covered the Fed for a long time. What are the policymakers there likely to focus on inside this report, and why are they likely to focus on it?
Right. So they are definitely going to be focused on the gain in what we call the core index, which is the one that strips out food and fuel prices, both of which jump around a lot from month to month. The reason that the Fed focuses on that index is because it gives you a sense of what underlying inflation trends are looking like. And the index was nothing but bad news this time. It increased pretty sharply. It was expected to increase a little bit more and reaccelerate a little bit from a slowdown last month. But what we saw was a really rapid pickup in that index. And so I think that is going to be a particular concern, especially because some of the reasons that index reaccelerated are really sticky. For example, rents moved up a lot, and those tend to be very slow moving.
And just to decode the word sticky, that means, in other words, that people thought this might dissipate, and it's not dissipating, which leads me to my next question. Have we been thinking about, have economists been thinking about the stickiness of inflation the wrong way? Is it more persistent than people have been thinking?
Economists have certainly got inflation wrong over the last year, 2 years. We all thought that inflation was going to pop up as the pandemic reopening happened and then pretty quickly fade. And that is clearly not what has happened. Inflation has been with us almost every month. You'll have economists saying, this might be the peak. We're at the peak now. This is the peak. And every month they are consistently wrong. We have not yet, had a consistent peak that really seemed durable. It may be the case that we peaked last month, but it's not obvious yet. And so I think there are real questions what is going to happen with this going forward. It's very hard to predict what is going to happen with these numbers. It's really sort of a brave new world for inflation in this sort of long pandemic era.
So if it's hard to predict, it does seem like traders on Wall Street are predicting. It seems like they're predicting a Fed increase and that these, well, let me ask you, what did you make of the sharp drops in all the indices on Wall Street? And what do you think they're predicting about the Fed and what that will then lead to the economy if the Fed raises rates?
Yeah, it's interesting. We've seen recently on Wall Street quite a lot of hopeful thinking about what the Fed is likely to do. They had really sort of dialed back their expectation for rate increases. And I think you got today's report, and it caused this really big adjustment where I think a lot of traders and investors took a look at what the Fed is likely to do and decided that the Fed is likely to be a lot more aggressive than they were thinking. And so what we see now is that Wall Street is really expecting a pretty big rate increase this month, maybe even a bigger one than has happened recently, which would be a big surprise compared to what they had previously anticipated. And that is why you saw those stock indexes sell off so sharply, because as investors expect a more aggressive Fed response, they also expect a more painful economic response to that Fed action. And so, this probably increases the odds of a recession, and it might increase the odds of very high unemployment.
So help me then translate what that means, that pain that you just described. We can get quite abstract when we talk about the Fed. Help people understand what, and this would be good. I mean, it would be good news for the Fed in terms of their strategy if things start happening that we would traditionally think of as painful. So walk me down what it might mean for businesses, for consumers, if the Fed takes stronger action than people were already predicting.
Yeah, I think that the real distinction here is between what we call a soft landing and a hard landing. So what the Fed, Wall Street, and everybody has been hoping is that we might be in a situation where the Fed could slow the economy just a little bit, take some of the sort of force away from inflation and allow prices to calm down, allow everybody to sort of do a little bit better with their take-home pay, as the labor market remains strong, but inflation slowed down. I think that reports like this make that much less likely. It is probably much more likely now that the Fed is going to have to stage a really aggressive response to inflation. And as it does that, we're going to see a rapid slowdown in the economy that could push unemployment much harder, which is what we call a hard landing.
Right. So fewer jobs, more people losing their jobs, and higher mortgage rates and that kind of thing. Jeanna Smialek in Alexandria, Virginia. Thank you so much for helping us through all that.